Hello everyone, my name is Ben with IncomeOptionsTrading, and today I wanted to go over the expected annualized return for the 0 days to expiration Iron Condor and SPX, popular in the tastytrade Facebook group. This was originally started by Tammy Chambless. I have had a lot of questions on what kind of return can you expect, so I figured I'd do a video on this. So first, just wanted to go over the SPX 0 days to expiration Iron Condor basics, just so everyone is on the same page. So the Iron Condor consists of both a short put spread and a short call spread. You can either sell both spreads as one order or split it into two. I usually split it into two separate orders, but it's just up to personal preference what you do. So the Iron Condor is on 0 DTE expirations, which is Monday, Wednesday, and Friday for SPX. If there's a holiday on Monday or Friday, then the 0 days expiration moves to Tuesday or Thursday. And one thing to note is once every month there is a PM settled or AM settled expiration, you do not want to trade the AM expirations because those expire Friday morning, and your last chance to trade them is Thursday night. And so you have overnight risk from Thursday to Friday, and the decay is not as fast on Thursday. So it's kind of like a pseudo 1 day expiration. So make sure you're always doing the PM settled expirations. In Tastyworks, all the PM expirations look like normal options. If it's an AM settled contract, it'll actually show AM on the platform. The delta of the short option should be around 5 or 10 delta. If you go higher than that, then your win rate drops. So 5 to 10 delta. And then I buy the first long that is 5 cents. So I go out as far as I need to. The calls are generally narrower than the puts because of the put skew. And buying the long that is 5 cents, that's just for buying power reduction, and that makes it a synthetic strangle. So then for each spread or Iron Condor, I set a stop loss on the short leg only at 3x the credit received on the short strike only, and that gives me a 2 times net loss. And on the profit side, I hold the trade expiration if the stop loss isn't hit. Some people close it early if you desire, but I usually do not. And then for more information, you can check out my YouTube video that I have in the description link below. And note that there are other variations of this trade available online. Traders should find what works for them. The returns will vary based on mechanics. So if you follow me on Twitter or the Facebook group, a lot of people have their own way of trading, different widths, different deltas, different profit and loss mechanics. So this is not the only way to do it. So you should find out what works for you. So now let's go over some of the Iron Condor risk basics. So for this trade, you should never risk more than 2% of your account in any one trade. And that just means that your 2x net loss should be a maximum of 2% of your account value. And that just makes it so when you have losing trades, you're able to trade the next day. And also your buying power reduction should be less than 50% of your account. So that's based on the spread width of the call and or the put side. And always respect the stop losses. This type of trade, these low delta trades, risk management is absolutely vital. And if you don't use that, a small loss can turn into a big loss pretty quick because of the gamma. And not following the above will increase your risk of blowing up your account using the strategy. So only use this strategy if you're an advanced level options trader. Alright, so first we're going to look at the put spread side of the Iron Condor, look at those returns. So, oops, there we go. Backtesting was done from January 2012 through December 2019. One contract each Monday, Wednesday, Friday, no re-entering, selling 5 delta or 10 delta short leg, and buying the 5-cent long leg. So first we'll look at the 5 delta short put side. So that one had a win rate of about 78.5%. The average credit was 44 cents. The max drawdown over the 2012 to 2019 period was about $2,000. Max loss on any given day was $145. The average spread width for the 5 delta short put was about $60. And the premium capture here was about 35.5%. So that means each day you're expected to bank about $15 per trade. So out of that $44 credit, you keep about $15 of that over the long run. So then looking at that annual return, if you do this every week, that's 52 weeks times 3, 156 trades per year, times that $15.62 per trade, and that is $2,400 per year. And that does not include commissions, fees, or slippage. So if we look back at the max risk of 2%, we have our $145, which was our max loss for any given day. Divide that by 2%, and your minimum account value for the 5 delta short put should be $72.50. So for every $7,250 in your account, you can trade one of these based on that 2% risk metric. Also, you should look at the 50% buying power reduction. So here the average spread width was $60. So that's about $6,000 per trade. I'm not including the credit, so it'd actually be $6,000 minus the 44, but this is just a rough number. So with that $6,000 buying power reduction, divide that by 50%, and you get a $12,000 account. So you take the worst case scenario. So for one 5 delta short put spread, you should have $12,000. So if you have a $24,000 or $25,000 account, this is saying that a maximum you should do is 2 contracts of the 5 delta short put spread. So now let's look at the 10 delta short put. Win rate is 75.5%. So you can see just a slight reduction from the 5 delta. Average credit is over double, 93 cents. Max drawdown is about double, about $4,000 over that time frame. Max loss on any given day is 512, and that's because of the higher credit. Average spread width for this one was about $75. So just slightly higher than the 5 delta short put spread. Premium capture for this one was about 25%, which comes out to about $23 per trade. So you make a little bit more, but you're also risking a little bit more with that 10 delta short put. And the annual return is about $3,500 per year. Again, that does not include slippage, fees, or commissions. And similarly, we look at the max risk of 2%. So that $512 max loss divided by 2%, you're looking at almost a $26,000 account to put on the 10 delta short put. Max BPR of 50%, so that spread width of $75 is $7,500 divided by 50% is $15,000. So for the 10 delta short put, you should have about a $26,000 account compared to a $12,000 account for the 5 delta short put. And then lastly, the 10 delta short put is about a 13.7% annual return based on the $25,600 account. I think I forgot to mention on the 5 delta short put, based on that $12,000 account, you're looking at about a 20% annual return. So a little bit higher annual return on the 5 delta short put, mainly because of the lower account minimum. So now let's look at the call spread side. Same time frame, one contract, Monday, Wednesday, Friday. So let's look at the 5 delta short call first. So win rate 75.6%, average credit 35 cents, max drawdown of $1,000, max loss of 116, average spread width of $25, which is quite a bit less than the put side. All of these numbers are quite a bit less than the put side, and that's just because of the put skew on the S&P 500. So then the premium capture is about 26.8%, which comes out to about $9 per trade. So not really a big money maker. Annual return based on 3 trades per week comes out to about $1,400 a year. Max risk of 2%, doing the same math as before. It's $5,800 account based on the 50% BPR rule. We're at $5,000 account. So on the call side, you want to have at least $6,000. And the nice thing about doing an Iron Condor is if you put on both the call and the put side, the margin requirement is just the larger of the two. So then the annual return based on that, those numbers are about 24%. So then let's look at the 10 delta. Win rate lower at 71.5%. Average credit about double, 73 cents. Max drawdown 2.5 times that of the 5 delta at 2,500. Max loss about 3 times, actually over 3 times at 410. Average spread, it's $35 width. Premium capture for that one is 14.5%, which comes out to just over $10 per trade. And the annual return is about $1,600 per year. So only $200 more than the 5 delta short call. So then the max risk of 2% should have about a $21,000 account. For 50% BPR, should have a $7,000 account. So based on the $20,500 account value, you're looking at about a 7.8% annual return. So then let's put the put and call side together and look at the Iron Condor as a whole and see how we did there. So below data is based on numbers and are only estimates. They do not include commissions, fees, or slippage. Low results will definitely vary. These numbers do not guarantee any results, and each trader is responsible for their own trades and risk only what they are ready to lose. So first box here, so we're looking at the annual profit and loss before commissions, fees, and slippage. One contract at open. On the top side, we have the calls, both the 5 delta and the 10 delta. And on the left-hand side, we have the puts with the 5 delta and 10 delta. So this $3,800 per year is if you do a 5 delta put and 5 delta call. This $5,100 is 10 delta call, 10 delta put, and $4,900 for the 10 delta put and 5 delta call. So you can see that the 10 delta on both sides gives you the highest actual return. But let's look at some other data here. So this is the max loss based on the backtesting. And you can see the 2 5 deltas would only give you about a $261 max loss, whereas the 10 delta calls and puts is about $922. So quite a bit more risk with doing the 10 delta options. Max drawdown, similarly, $3,000 for your account if you do the 5 deltas, and it's $6,500 about for the 10 delta. And you can see if you want to do the 10 delta put and 5 delta call, the drawdown is $4,500, and the max loss back here is $555. And then the next one, minimum recommended account size. So for the 5 delta calls and puts, you should have about $12,000 in your account compared to about $26,000 if you're going to do the 10 delta put. So it doesn't matter if you do the 5 delta or the 10 delta call. If you do the 10 delta put, you should have about $26,000 in your account. And if you do the 10 delta call and 5 delta put, you should have about $20,500. So again, this kind of points to using the 5 delta on both sides, just kind of from an efficiency standpoint. And you can see that here with annual return based on the minimum recommended account size. Your return is about 31.7% for the 5 deltas, and you're just in that 19 to 20% range for the other 3 combinations. And this is just one contracted open, so you could also do 1 put contract and 2 call contracts if you want to mix and match. But there's a lot of combinations. I didn't want to go into all of those. So based on this data, actually, I typically do the 10 delta on both sides. But after looking at these numbers a little bit closer, I think I'm going to reduce my delta and go more towards the 5 delta on the calls and puts. I think they're a little bit more efficient. So hopefully you guys found this video worthwhile. If you have any questions, please leave them below. Thank you.